It's Friday, 20th of March, 2026. Welcome back to your news update on Blip Brief, crisp, but almost everything updated every market trading day. And if you are looking at your portfolio this morning, you are seeing firsthand what happens when an invisible string connecting a gas field in the Middle East to a small cap stock in Mumbai just suddenly snaps.
Yeah, it's a completely brutal morning for the markets.
It really is. I mean, we are navigating a landscape defined by absolute capitulation today. Indian equity benchmarks just recorded their steepest single-day decline in nearly 2 years, plummeting by over 3% across the board.
Right.
And the fear gauge, the India VIX has just violently woken up. It's surging over 22%.
It is. And the critical takeaway for you listening right now is that this violent downward movement,
Yeah.
it's not rooted in some sudden domestic flaw, right?
Yeah, the fundamentals haven't changed overnight.
Exactly. The Indian corporate earnings engine has not stalled out. The domestic consumption story hasn't broken. What we're witnessing today is an external geopolitical shockwave that is just aggressively repricing assets globally.
Because of the oil shock.
Right. Global crude prices jumped over 4% in a matter of hours. And this is a direct, immediate reaction to those tit-for-tat military attacks in West Asia, just escalating dramatically.
Right, we are no longer talking about minor skirmishes here.
No, not at all. We are seeing strikes aimed directly at the heart of critical global energy infrastructure.
And the specific targets are really what's driving this panic. I mean, we are talking about direct hits on Iran's South Pars gas field, severe disruptions to Qatari LNG infrastructure, and highly coordinated strikes on Saudi energy assets.
Yeah.
The global oil and gas supply is essentially, it's the global economy's central nervous system. When a major nerve is severely pinched in the Gulf, markets everywhere just immediately spasm.
They do. And you see that contagion cross borders instantly.
Exactly, because Wall Street felt the exact same tremor. Major tech players slipped, with Nvidia down 1% and Tesla sliding over 3%.
Yeah.
But I need to unpack the underlying mechanics of this panic with you. Like, is the market reacting to actual physical supply shortages of crude right this second? Or is this just a massive repricing based entirely on the fear of what prolonged inflation will do to the system?
Well, it's almost entirely the latter, though the physical risk is certainly rising with every passing hour.
Right.
Policymakers and institutional trading desks, they are just reacting to today's missing barrels of oil. They are bracing for a sustained supply crunch.
Because of the scale of the damage?
Precisely.
Yeah.
Think about the infrastructure we're talking about here. When you severely damage complex facilities like the South Pars field or, specialized Qatari LNG terminals, you aren't simply delaying a few cargo shipments.
You're taking it offline completely.
You are structurally removing future energy capacity from the global grid for a completely unknown period. And that instantly revives the ghost of sticky, entrenched inflation.
Because energy isn't just one isolated sector. I mean, it is the baseline input cost for literally everything else in the global economy.
Exactly. It dictates the cost of the plastic in your phone, the fertilizer for your food, the shipping cost of your goods.
Yeah.
So when that baseline cost rises abruptly and unpredictably, inflation expectations just become completely unanchored. And consequently, markets are forced to reprice risk entirely.
Right, because higher, stickier inflation means central banks simply cannot come to the rescue with cheaper money if the economy slows down.
Exactly. The discount rate that analysts use to calculate the value of future corporate earnings, that goes up. And therefore, current stock valuations must come violently down to match that new reality.
And that macro fear of sticky inflation, it translates directly into rapid capital flight, which really explains the severity of the massive sell-off we're seeing right here at home.
Yeah, the outflow is historic.
It is. Foreign portfolio investors, the massive global funds, they are currently executing their largest continuous percentage withdrawal from Indian equities in 2 decades.
2 decades. It's staggering.
This exodus has spanned the last 15 trading sessions without a single break. And when we look under the hood of this sell-off, it is the small cap stocks that are bearing the absolute brunt of the panic.
Oh, absolutely.
They are seeing a significantly steeper percentage fall in valuation compared to their large cap peers.
And that is the classic textbook definition of a flight to safety mechanic. Small cap stocks inherently carry a much higher risk premium.
Right.
In a roaring bull market, investors are more than happy to pay that premium for the promise of hypergrowth. But the moment geopolitical uncertainty spikes and global liquidity threatens to tighten, that risk appetite just completely vanishes.
Because the exit door for small caps is incredibly narrow, right?
Precisely. Institutional investors look at their heavily diversified portfolios
Yeah.
and immediately move to dump their most illiquid high-risk assets first to raise cash.
Yeah.
Small caps simply do not have the daily trading volume to absorb massive institutional sell orders without the price just cratering.
Right. When a massive global fund wants out of a small cap position, there are simply no buyers at the current price.
None. The bid-ask spread widens dramatically. Everyone tries to rush through that narrow exit door at once, and the valuations collapse disproportionately as a result.
Okay, but I want to challenge the sheer scale of the panic narrative we are seeing on the tape today.
Sure.
If foreign institutional money is fleeing at this historic, record-breaking percentage rate, why hasn't the floor completely fallen out of the market?
That's the real question.
Right. Because a 2-decade record in continuous foreign withdrawals should technically trigger a total free fall. Yet the broader indices, while undeniably down significantly, haven't completely broken their fundamental market structure. What is actually holding the line here?
Well, you are pointing to what is arguably the most vital structural shift in the Indian financial system over the last decade. The floor hasn't collapsed because domestic mutual funds have acted as a massive systematic shock absorber. While foreign capital is aggressively pulling out, domestic institutional investors are stepping in to buy the dip. They are aggressively buffering the foreign dump.
And that domestic institutional power is fundamentally retail money, isn't it? It's the automated inflows from retail SPs.
Yes.
It is essentially blind capital.
It is blind, but it is relentless. Think about the mechanics of an SIP. A percentage of a retail investor's salary is automatically deducted on the first of the month and injected directly into the market, regardless of the headlines.
Yeah, it doesn't care about the news cycle.
Exactly. It demonstrates a profound evolution and maturity in Indian retail capital. 10 years ago, a retail investor might have panicked at the sight of a Middle East conflict and halted their investment.
Right, pulled everything out.
Today, they aren't stopping their contributions. Instead, that steady, automated stream of domestic liquidity is absorbing the shockwaves of global geopolitical capital flight.
They are effectively buying the assets that foreign funds are desperately liquidating.
Spot on.
That domestic resilience is a fascinating evolution, but it brings us to a specific domestic heavyweight that actually dragged the entire banking sector down today, overwhelming even that relentless domestic shock absorber.
Yeah, the HDFC situation.
Exactly. We need to zoom in on HDFC Bank. The shares saw their steepest single-day percentage drop in 21 months, plunging over 5%.
And for a stock that accounts for such a massive weighting in the benchmark indices, a drop of over 5% isn't just a bad day for the company.
No.
It is a systemic drag on the entire market. What makes this so compelling is that the catalyst wasn't a bad earnings report. It wasn't an expansion of non-performing assets or some macroeconomic shift.
Right, it was purely governance.
It was a sudden, jarring corporate governance jolt. The abrupt resignation of the non-executive chairman sent immediate shockwaves through the institutional community.
And it was his phrasing, wasn't it?
Yes, specifically, it was the phrasing in his exit note, where he explicitly cited that certain practices were not aligning with his personal values and ethics.
And that specific phrasing, values and ethics, I mean, that is completely radioactive in the financial sector.
Oh, absolutely radioactive.
Both HDFC management and the Reserve Bank of India immediately stepped in to try and soothe the market panic. They issued rapid statements claiming there are absolutely no material governance issues.
Right.
Essentially telling investors that the core operations, the loan book, and the balance sheet are perfectly sound.
Yeah.
But clearly, looking at the tape, the market didn't buy it for a second.
Not at all.
So why does one vague, undefined comment about ethics from a departing chairman completely overpower the official, formal reassurances from the nation's central bank?
Well, think of corporate governance at a systematically vital bank like a massive Jenga tower. The balance sheet, the loan growth, the branch expansion, those are the blocks at the very top.
Okay.
They might look incredibly stable, but the board's integrity, the ethics, that is the foundational block at the very bottom.
Oh, I see.
When a chairman pulls that bottom block on his way out the door, it instantly compromises the perceived structural integrity of the entire tower, regardless of how stable the top looks.
Right.
The actual currency of a bank isn't its consumer deposits. Its ultimate currency is institutional trust.
And institutional fund managers operate on the principle of asymmetrical risk, don't they?
Exactly. Put yourself in the shoes of a portfolio manager right now. The upside of waiting to see if the RBI is right is minimal. Maybe the stock rebounds a few percentage points.
Right.
But the downside of holding the stock, if a massive systemic governance scandal is about to break,
It's catastrophic.
it is. You could lose your job and your fund could face massive redemptions.
Hmm.
So they shoot first and ask questions later. They simply refuse to hold the bag while the dust settles, regardless of what official press releases are distributed.
And that institutional fear of the unknown perfectly bridges us back to the global cost of money. Because global central banks right now are operating in their own black box of uncertainty.
They really are.
We are seeing a fascinating, almost anxious paralysis among central banks in how they handle these converging dual crises of sticky inflation and geopolitical instability.
Yeah.
The European Central Bank and the Bank of England are holding their rates completely steady. They're essentially freezing their policy in place while they wait to see what happens.
Right.
But in the U.S., the narrative is taking a very aggressive, very consequential turn. Speculation is rapidly mounting that if Kevin Warsh officially takes over as the new Fed chair, he might actually have to execute a rate hike.
And make no mistake, a rate hike in this highly fragile environment would be a massive shock to the global system.
Yeah.
Warsh is historically known for a deeply hawkish stance on inflation. As we discussed earlier with the oil shock, the sudden surge in crude prices threatens to unleash a powerful secondary wave of inflation. If the U.S. Federal Reserve signals that they are willing to hike rates to combat this oil-driven inflation, it fundamentally alters the global flow of capital. Yields on U.S. government debt would rise significantly, making the U.S. dollar incredibly attractive to global investors who are desperately seeking both high yield and absolute safety.
Right, so capital would immediately drain from emerging markets and flow directly into the U.S. dollar.
Precisely.
And that expectation of a hyper-strong U.S. dollar leads us to one of the most perplexing commodities trends of the week. Because despite a raging, escalating war in West Asia, despite global supply chains being threatened, gold has actually dipped nearly 5%,
Yeah.
and silver has plummeted over 12% over the past week.
I really have to push back on conventional financial wisdom here because this makes no intuitive sense.
It doesn't, does it?
No. The absolute golden rule of finance is that when wars break out, when bombs drop, and geopolitical fear spikes, investors flock to gold as the ultimate safe haven. Why on earth is it tanking during a major global crisis? It is a brilliant paradox, and it perfectly illustrates how interconnected and ruthless these macroeconomies really are.
Okay.
The answer lies in the strict hierarchy of market drivers. Yes, historically, gold is a geopolitical safe haven, but fundamentally, gold is an asset that yields absolutely zero interest.
Right.
You buy it, it sits in a vault, and it pays you no dividend, no coupon, nothing.
So it's completely about opportunity cost.
Precisely. Because the surge in oil prices has drastically spiked U.S. inflation expectations, the market is aggressively pricing in a much stronger U.S. dollar and the high likelihood of sustained elevated interest rates.
Like that hawkish rate hike from the Fed we just discussed.
Exactly. When the U.S. dollar is hyper strong and an institutional manager can get a high risk-free yield just by holding U.S. treasuries, the opportunity cost of holding zero-yield gold becomes mathematically indefensible for their portfolios.
Wow.
The cold, hard mechanics of a strong dollar and high interest rates are completely overriding the traditional emotional wartime safe haven reflex.
It is a ruthless mathematical calculation overriding centuries of historical sentiment.
It really is.
We see these massive, incredibly complex macro systems, global supply chains, institutional risk models, central bank monetary policies, all reacting to the disruption of their fundamental inputs. We've spent this entire time talking about how cutting the fuel lines of the global economy, crude oil, halts the entire system.
Right.
But scientists have just discovered they can use that exact same macroeconomic principle to halt one of the deadliest microkillers on Earth.
The malaria parasite.
Yes, it turns out it has a fuel line too, which brings us to a really fascinating scientific breakthrough to close out today. Scientists have just solved a long-standing biological mystery, discovering that malaria parasites are essentially propelled by tiny rocket engines.
It sounds like pure science fiction, but the biological mechanics governing this are incredibly elegant.
Yeah.
For years, scientists have observed under microscopes that malaria parasites move through the human host's body with surprising speed and brute force.
Right, they just power through.
Navigating through the human bloodstream and cellular barriers is, Well, it's like swimming through thick molasses for a microscopic organism.
Yeah.
It requires immense power.
Okay.
But the exact propulsion mechanism, the engine generating that power, was a complete mystery until now. Researchers have discovered that these parasites contain specialized, fast-spinning crystals.
And these crystals are essentially acting as the biological engines.
Yes, by utilizing a localized, highly volatile chemical reaction that mimics a rocket thruster.
Wow.
These spinning crystals actively break down hydrogen peroxide found within their immediate biological environment. When hydrogen peroxide breaks down, it undergoes rapid catalysis.
Okay.
This chemical breakdown releases a sudden, powerful burst of explosive energy, allowing the parasite to literally rocket its way through the dense cellular barriers of the host.
It is a microscopic masterclass in converting chemical energy into kinetic propulsion. And understanding this isn't just, an interesting piece of trivia for a biology textbook.
No, not at all.
It has massive world-changing implications for global health. If we now know exactly how the parasite's engine works, and crucially, what specific chemical fuel it relies on to achieve that propulsion, this could be the master key to designing a completely new class of future drugs.
Exactly. We could theoretically design highly targeted therapeutics that specifically attack those spinning crystals or neutralize the hydrogen peroxide reaction entirely.
Right.
Just as the global economy stalls when its energy infrastructure in the Gulf is disrupted, the malaria parasite can be completely stopped in its tracks if we can disrupt its internal energy conversion.
You are essentially cutting the fuel lines of these deadly parasites before they have the kinetic energy required to propagate through the body.
Spot on.
It shows that whether we are looking at the vast complexity of macroeconomics or the microscopic intricacies of human biology, understanding the fundamental mechanisms of propulsion, energy, and fuel is the ultimate key to solving the system's problems.
It's all connected.
Which leaves us with a critical thought for you to mull over as you watch the markets open today. If disrupting energy at a microscopic level can cure a deadly disease like malaria, and disrupting it at a macro level can crash global economies and rewrite central bank policies, it begs the question, how fragile are the engines powering our own biological and financial systems that a single spark of friction can bring them both to a complete halt? Think about that as you navigate today's volatility.
Good luck out there today.
And just before you go, a quick note, this deep dive commentary was put together using advanced AI. We always strive for accuracy, but please do cross-verify any crucial information yourself. Your informed decisions are what matter most. The content shared here is for informational and educational purposes only and should not be treated as investment or trading advice. Past performance is not indicative of future returns. We are not licensed financial advisors.